We're giving a quick update on the mortgage market. A lot of people have questions about real estate. It's been choppy the last few weeks. So I figured let's hop on this, see if anybody has any questions. Maybe we'll pull a couple Italians in from the sidelines. Picarazzi's a pretty good one we could probably bring in here. Yeah, my little nephew, Nicky, love that. So right now, the market's definitely been turbulent the last couple of weeks. There's a lot of fear. People are nervous with what's going on. And honestly, the media is making it a lot worse, at least I think, than it really is. Now, right off the bat, rates are at 7.5%. They came down to like 7.25% today. So mortgage rates got up to 7.5%. They came down a bit today. Today was actually the largest drop the 10-year Treasury had since 2009. But the big thing is, with fear, I think there is opportunity. It's going to be a good time for people to step in and pick up deals that weren't available, let's say, definitely a year ago, but even 3 to 6 months ago. So that's my thoughts there. What do you think, B? Would you agree with that?
100%. Yeah. Rates definitely right now are very high, or higher than what we've seen. And the volatility has increased. So they're jumping up and down by, almost 0.5% some days.
Awesome. And, the Fed's going to continue to hike rates. They've hiked rates 300 basis points this year. Now it's the federal funds rate. It doesn't directly correlate to mortgages or the mortgage rates, but any variable rate loan is going to increase with the federal funds rate going up. They're projected to increase the Fed funds rate another 125 or so basis points by the end of this year. That's priced in, and if they continue to hike that, it becomes more expensive to borrow. Car loans, HELOCs, a HELOC that we took out, a year ago had a rate of 4.25. It's now like 7%. So as the Fed continues to raise rates, these great, so many Italians in here, it's great. It's like Mill River on a Friday night.
Joey Carbone.
As the Fed continues to raise rates, it's going to get more expensive to borrow money. One thing that we've been having conversations with clients and investors, and even some agents of ours, is now is actually a pretty good time to buy, not from a mortgage rate perspective, but in regards to rates going up has killed demand. We've seen demand fall off a cliff. So if you're looking to buy a home a year ago, you were paying 10, 15, 20% over ask. In May, early June, we closed on a house, we paid 25% over ask in Fairfield. Today, you don't have that much competition. There's not that many buyers that there were a year ago. And contingency, so mortgage, inspection, and appraisal, we waived all of those 6 months ago. Today, people are including those in their offers. So it's definitely a better time there. Also, Hubbard clause. If you're living in a home and you want to sell it first before moving, we had an accepted offer a week ago with a Hubbard clause, which a year ago, good luck, see you later, smell you later, no way.
One more thing, G, going on that, you're going to see people are a lot more willing to negotiate now. They're not getting as many offers on the houses, so if they do see an offer, they're going to be more willing to negotiate if it's just that one other offer.
100%. And listing agents are more accepting to negotiate. They're sharing more information right now. Seller credit. I remember a year ago, people were asking me about seller credit. I'm like, dodge and weave. Like, I don't know what that is. Good luck. Today, I just had a conversation with a client, full seller credit, hopefully, is what they're going to be aiming for. So that's the plan. I mean, rates 7.5% today. Fannie Mae predicts that by spring, it'll be about 4.5%. Let's see what those projections are going to be in that time, if they update those over the next month or two. But if rates are at 4.5% in spring, every loan that we're writing today, people are going to refinance. They're going to get a loan today at 7%, refinance even at, let's say, 5% in 6 months from now.
So the big opportunity is right now finding a deal at a discount. Go to somebody who's willing to negotiate or work with you to get a lower purchase price.
100%. One thing, though, with loans, too, that, touches on loans being originated today have a high chance of being refinanced in a few months, within, let's say, a year to 18 months, is this changes the way loans are priced. So we're seeing a lot of people that are buying homes, especially investment properties, having to pay, if they're buying a primary residence, about a point at least. If they're buying investment properties, 2, 3, 4 points to buy a home. The reason for that is when a loan is originated, there's a par rate. Because there's a high chance that it's going to be refinanced and paid back in full in the next, let's say, 12 to 18 months, they're charging people these points up front. That is, I'm laughing at some of these comments, is, to kind of recoup that money. So we're not seeing any par rates for anyone across the board. It's very rare that somebody's not having to pay any points at all. And just so everybody knows, a point is a percent of the loan. So if you're buying a home for $400,000, that's the loan amount. A point is 4,000. Doesn't mean that your interest rate goes down 1%. So if the rate is 7% and you pay 1 point, your rate doesn't go to 6%. Probably goes like 6.625% or 6.5%. So that's what a interest rate or a point is there. The biggest thing too, V, with conversations I'm having with people is being an advisor right now. We're seeing a lot of clients, be fearful, not sure what's going on in the market. And you have to really just come from not just I'm trying to sell you a home or help you with a loan. It's big picture. It's like I'm being your lender for 30 years, not 30 days. I'm not going to give you a loan and then disappear. We're planning, budgeting, saving. What are we going to do with those savings and invest them? Then we're looking at credit repair, connecting them with maybe financial advisors for the long term. So I think for us agents, other people in the business, super important to start making that shift as well. And with all the consultation calls I'm having, I'm bringing that up. Like, do you have somebody that you're working with on the financial aspect side? Because a lot of my clients are thinking about their long-term savings goals, especially with the market getting whipsawed back and forth. The Dow, the S&P, all that good stuff. Mm-hmm. So I think that's super important. I guess one thing too that we go over is requirements for a loan right now that people should at least be aware of is, the big thing that we say is credit income assets, CIA. So assets, down payment. The minimum amount that you need for a home loan is about 3%. If you include closing costs, you might want to have a little bit there too, but you could probably roll those into the loan. So of the purchase price, you want to have like 3 to 6%. If you get 5 or 6, you're in a great spot. In regards to credit, the minimum credit score for a home loan is 580. National average is about 680, and anything above 740 is considered top tier. So if you're in that 600 range, you're going to qualify. If you're in the 700 range, you'll have no problem whatsoever. And then income, we base it off a debt to income ratio. Ideally, you want to have clients be at a DTI of 40% or lower. What that means is if you make $10,000 a month, your total debt, mortgage, car payment, credit cards is $4,000 or below. So we want to make sure you don't want to have a 50% DTI. You might qualify for that, but then you're going to be house poor. You're not going to have any money for vacations, what car you drive, going out, all that good stuff. So that's definitely something to keep in mind. The assets, the big thing there is they can come from any account as long as they're verified and seasoned. So as long as they've been in the account for 60 days and as long as we can verify where they've come from. And then the one thing too that I was having a conversation, easy way to figure out how much you qualify for, like back of the envelope, like you don't know anything else. Look at your gross income, multiply that by 4 or 5 times, and that's what you're going to roughly probably qualify for. You do want to speak to a lender to hammer that down, but it'll give you a rough idea. If you make $100,000 a year, you're probably going to qualify for $400,000 to $500,000. The last thing that I'm going to talk about, V, and then if you have any thoughts you want to add, is anything variable rate has seen rates go through the moon. So HELOCs, credit cards, and some car loans. So it's getting more expensive to borrow. Any loan that we do originate, we're going to be probably refinancing 6 months to 18 months down the road. And that's a quick recap I have. You have anything you want to toss in there?
Yeah, the one thing I'll say is look at the purchase price now. If you could get a deal for it, don't worry about the rate. You'll end up refinancing that. Like you said, Fannie Mae expects rates to come down to 4.5%. So long term, look at the long term picture. Try and get a good deal now.
Awesome. That's a quick little 10-minute update. Love it. I'm gonna hop back on calls, but appreciate everybody hopping in, saying hi. Had some funny, a good crew in here, and we'll be in touch soon. See you, babe.
See ya.